Interest was once considered more dangerous than theft. Long before stock markets, before credit cards, before modern banks, entire civilizations feared one simple idea, that money could grow on its own. Not through work, not through production, but through time. That fear wasn't superstition. It was experience. Because once debt begins to multiply faster than real life can sustain it, something breaks. And that ancient tension still sits at the center of modern banking, inflation policy, government debt, and global financial power. If you understand where interest truly began and why rulers tried to contain it, you start to see today's financial system differently. You see why credit expands endlessly. Why sovereign debt never seems to disappear. Why inequality compounds. Why crises repeat. Tonight, we're not telling the textbook story of money. We're uncovering the hidden system behind it. A system that began in temples, spread through empires, triggered religious bans, forced royal debt cancellations, and ultimately evolved into modern central banking. But to understand interest, we have to dismantle the first myth. Money did not begin as barter. There was no ancient world where strangers wandered around, desperately trying to swap chickens for sandals. Large societies did not function on coincidence. They functioned on obligation. In the earliest cities of Mesopotamia, places like Uruk, economic life revolved around temples and palaces. Farmers received land, tools, and seed. In return, they owed part of their harvest. That obligation was recorded on clay tablets. Not traded, recorded, measured in units of grain or silver weight. This is the first revealed truth. Money began as accounting, as a way to measure who owed what to authority. The unit existed before the coin, before circulation, before markets. And once obligation was recorded, something else emerged quietly: interest. Agricultural lending created the problem. A farmer borrows grain to plant. The lender demands repayment after harvest. But because time passes and risk exists, the lender demands more than was borrowed: extra grain, extra silver, compensation for waiting, compensation for uncertainty. Interest was born not from commerce, but from agriculture. And it came with a terrifying property. It could grow automatically. Interest existed before coins, before banks, before modern governments. In temple economies, interest rates were standardized, often high. Grain loans could carry rates that doubled over time. Silver loans accrued fixed percentages. And that multiplication created tension. Because crops don't always double, labor doesn't automatically compound. Real production is limited by nature, but interest is not. Here is the deeper truth. Interest introduced a structural imbalance. Debt could grow faster than reality. And when it did, society destabilized. If a harvest failed, the debt still compounded. If a family couldn't repay, land was seized. If land was seized, independence disappeared. Debt slavery became common. People lost farms. Children were pledged as collateral. Entire households fell under creditor control. This wasn't rare, it was systemic. And rulers began to notice something dangerous. When too many citizens became debt slaves, the economy shrank. Tax revenue collapsed. Military recruitment weakened. Revolt became likely. The system designed to create wealth began eroding social stability. So kings intervened. In Mesopotamia, rulers periodically declared debt cancellations, clean slates, obligations erased, land returned. These weren't acts of mercy. They were acts of survival. Interest had to be controlled, or it would consume the base of society. That fear echoed across civilizations. In ancient Israel, debt forgiveness became embedded in law. The Jubilee reset wasn't symbolic. It was economic stabilization. In ancient Greece, excessive debt triggered unrest. In Rome, plebeians revolted against patrician creditors. Interest wasn't just a financial issue, it was political. It determined who owned land, who held power, Who could vote? Who could fight? Over time, religious institutions began addressing the problem. Charging interest on fellow citizens was condemned in many traditions, not because profit was evil, but because compound growth without limit threatened cohesion. The prohibition of usury wasn't primitive morality, it was social engineering, a boundary around a dangerous mechanism. Because once interest becomes normalized and unrestricted, wealth concentrates. Gradually, mathematically, inevitably, and that's the midpoint twist. Interest was not celebrated at first as a driver of growth. It was feared as a destabilizer. It allowed creditors to accumulate claims on future production without producing anything themselves. It shifted power from labor to capital, from farmers to lenders, from citizens to elites. But here's the turning point. As empires expanded, war became constant. War required funding. Funding required borrowing. Borrowing required lenders. And lenders required interest. States began legitimizing interest, selectively. Charging interest became acceptable when financing rulers, when funding armies, when expanding territory. Debt moved from household survival to imperial strategy. In medieval Europe, merchant bankers emerged as power brokers. Families like the Medici mastered the art of lending to monarchs. Kings needed money immediately. Taxes arrived later. Interest bridged the gap. Now the imbalance grew larger. Entire populations worked not only to feed themselves, but to service sovereign debt. Interest turned future labor into present capital. And whoever controlled that conversion controlled leverage. The creation of the Bank of England formalized this alliance between state and creditor. It was founded to manage government borrowing for war. Private investors funded the crown. In exchange, they received guaranteed interest backed by taxation. Public debt became permanent. This was revolutionary. Before, debt crises required resets. Now debt could roll forward indefinitely. Interest payments became institutionalized. Taxes became predictable streams for creditors. The modern system took shape. Commercial banks expanded the model further. Under fractional reserve banking, deposits become the base for new loans. New loans create new money. That money enters circulation as debt. And that debt carries interest. Money creation and interest become inseparable. Here's the structural reality. If all money enters the system as interest-bearing debt, more must always be repaid than originally created. To avoid collapse, new debt must constantly be issued. Expansion becomes mandatory. Growth becomes structural. Inflation becomes a management tool. Central banks adjust interest rates to control expansion. Too low, and bubbles inflate. Too high, and economies contract. But the mechanism remains the same one feared thousands of years ago. Debt growing over time. Compound interest transforming time into leverage. Now scale that globally. Governments borrow trillions. Corporations refinance endlessly. Households rely on mortgages, credit cards, student loans. Compound interest shapes entire life trajectories. Mispayments and penalties multiply. Delay repayment and balances swell. The system rewards those closest to credit creation. Asset owners benefit from expansion. Debtors carry the burden of time. Wealth inequality widens not only through corruption or policy mistakes, but through mathematics. Compound growth concentrates. It always has. Institutions like the International Monetary Fund lend to struggling nations. Loans come with interest. Interest requires austerity. Austerity reshapes economies. Debt becomes geopolitical leverage. Countries surrender policy autonomy to service obligations. The logic mirrors ancient temples. Recorded obligations, measured in standardized units. Enforced by authority. But here's what changed. Instead of periodic jubilees, modern systems resist resets. Defaults trigger market panic. Debt forgiveness threatens financial stability. So obligations roll forward, restructured, extended, refinanced. Compound interest continues quietly in the background. And most people never question it, because interest has been normalized. It's taught as neutral, as the price of borrowing, as incentive. But its deeper nature remains unchanged. It transfers wealth over time from those who borrow to those who lend. It amplifies advantage, it punishes delay. It demands growth, and growth cannot be infinite. That is the tension embedded in the system. Ancient rulers understood it instinctively. Left unchecked, interest could hollow out society. Modern policymakers attempt to manage it through regulation, monetary policy, and fiscal tools. But the structural incentive remains. Credit expansion fuels economies. Asset prices rise, debt grows. And eventually, reality catches up. Financial crises are not accidents. They are pressure releases. Moments when debt growth exceeds productive capacity. Moments when compound math collides with physical limits. The question is not whether interest is evil. It isn't. It enables investment, coordinates risk, allocates capital. The deeper question is control. Who sets the rates? Who receives the payments? Who creates the credit? And who absorbs the collapse when expansion fails? If interest allows money to multiply faster than real goods and services, then power naturally flows toward those who control its issuance. In ancient temples, that power rested with priests and rulers. In medieval kingdoms, with bankers and monarchs. Today, it sits within central banks, financial institutions, and global capital markets. Different names, same mechanism. Money began as recorded obligation. Interest transformed obligation into compounding leverage. Fear emerged when leverage destabilized society. Regulation followed. Institutionalization replaced prohibition. And now the system is global, invisible, normalized, but still driven by the same force that worried ancient kings. Debt growing through time. If you look at modern headlines, rising interest rates, sovereign debt ceilings, inflation targets, you are watching the management of that force. You are watching attempts to balance growth with stability, to prevent compound math from overwhelming production, to keep leverage from becoming collapse. The birth of money was not the birth of trade, it was the birth of obligation. The birth of interest was the birth of time as a weapon in finance. And the question that haunted early civilizations still lingers. If debt must grow to sustain the system, who ultimately controls it? And when the cycle reaches its limit, who pays? The ledger is digital now. The temples are central banks. The tablets are spreadsheets. But the tension between production and compounding obligation remains unresolved. Interest was feared for a reason. Not because it was immoral, but because it was powerful. And power, when concentrated and left unchecked, reshapes societies. The system didn't disappear, it evolved. And it still defines the dark architecture of global finance today.